Welcome to this Magellan update, which is part of our Magellan in Review 2021 series. I'm joined today by Dom Giuliano, who is our Deputy CIO and Head of ESG. We'll be discussing the growth of ESG investing and some of the catalysts that have led to that growth in the last 12 months, as well as Magellan's definition and our approach to ESG and sustainable investing. Dom, thanks for joining us today.
Thanks, Jen. Good afternoon.
Dom, the investment and advice industry are experiencing intense interest and news flow on sustainability and ESG. Why do you think there's been a surge in interest over the last few years?
Well, just before I dive into the answer, let me just remind listeners that ESG stands for environmental, social and governance issues and risks. In terms of the incredible growth in interest that we've seen over the last number of years, it seems that every investing headline relates to ESG or sustainability in some fashion. I think, at a high level, you could probably drill it all down to probably 5 big reasons. The first is population. I mean, it's as simple as that. There's 5 times more of us on the planet now than there were in the year 1900. And each one of us consumes a hell of a lot more than our great-grandparents did. And of course, that is going to place stresses on the planet and on social issues as well. The second big item that we need to think about is actually globalization. And what that actually means is that the consumer quite often is really, really far from the producer. And so there's very complex supply chains and sometimes they're very opaque, and you actually just don't know where things come from, how they were made, how they were sourced, and that creates issues. And then thirdly, you've got communication. Communication is obviously a lot better now than it used to be, and so you can see events and issues unveil in real time, and it makes things up close and personal. So when you see the dam busting, the Vale dam busting in Brazil and killing hundreds of people, you see that on your news. When you see kids digging up cobalt in the mines in Angola and in the Congo, you see that. The fourth is obviously social media. Both politicians, political groups, activists, influencers quite often have particular issues which then get amplified to us daily on our mobile phones. And then the last one is regulation and political interventions, governments in essence. And of course, you've seen very large interventions in things like the Paris Accord, but also things like modern slavery, which are impacting many governments around the world. And if you think about those 5 things that I've just gone through, none of them are going away, right? Those catalysts are going to be with us for the rest of our lives. And so we might as well get used to issues around sustainability and ESG and really try and understand what they mean.
An area of confusion or complexity within sustainability and ESG is that everyone seems to have their own definition of it. How do you think about it conceptually?
Yeah, everyone does have their own definition of it, and everyone's got their own little touch points. But I think you can actually drill down into first principles in terms of what ESG issues and sustainability issues are really around. And at the heart of all ESG risks is an economic concept called externality. So what is an externality? Let me give you a couple of examples. Firstly, from a definitional perspective, when a producer produces a good or service and it creates a cost on somebody else and the producer is not bearing that cost, that is an externality. And it works in both ways. A producer could actually create a benefit and not receive money for that benefit. That is also an externality. So if I give you a couple of real life examples, think back 30, 40 years ago, we were filling up our cars with leaded petrol. And as a consumer, you put 20 litres of petrol in the car and you go away and you drive. And meanwhile, whilst you're driving, you're pumping leaded fumes into the atmosphere, and it's actually having really, really, really bad impacts, particularly on children who are breathing in those fumes. So you've imposed an environmental cost on others that you are not bearing. Similarly, at the producer level, at the retail level, think about those $5 cotton T-shirts or those $15 jeans that some stores use to drag you in. Well, where's the cost involved in that? Well, potentially there's labourers working under awful conditions in Bangladesh and elsewhere to make those garments so cheap. So that's what an externality is. And if you just think about it, all ESG issues at their heart have one of those types of issues in there. And so you can think about ESG issues by yourself using that externality framework. Is there a benefit or a cost? in the production or consumption of something that is being born or received by someone else.
And Dom, how does the Magellan Sustainable strategy address the concerns that investors are seeking to address?
Yeah, so our framework, I think, is very clear and transparent and deals with the ESG risks. So there's two parts to the framework. The very first part is simply around exclusions. And we do this with a number of risks that most people would agree are detrimental to society. So we exclude companies with material exposures to alcohol, to tobacco, to exposures to adult entertainment, to gaming, to extraction of materials. So those companies are excluded. And for everything else that remains in our universe, we think about risks, ESG risks from a materiality perspective. Are they going to have a material impact on future cash flows and valuation? And if these risks really are of issue and that management can't deal with them, they will manifest themselves within our future cash flows and within future valuation, and we have to recognise and deal with that. And so there's two parts to that framework. It is really important to understand that we're looking at this from a forward-looking, long-term perspective, and we're thinking about this from the perspective that we are stewards of your capital. How do we deal with these ESG risks in such a way that over the longer term, managements can deal with them and that we can actually manage the risks within a portfolio over the longer term?
The last couple of years have seen some incredibly important social issues impacting countries, communities and businesses. Let's start with COVID. How have the challenges in the last 12 months been considered within the investment process?
Yeah. Look, there were a number of stocks within our portfolios across Magellan that were impacted by COVID in quite a material way. And where we could see that we could work and engage with companies to improve and sustain long-term values in their businesses, we did. So for example, in two areas, we actually reached out to chief executives and proactively engaged with some of the quick service restaurant chains in our portfolios to let the CEOs know that we weren't concerned about short-term costs, that we were not expecting them to cut costs whilst revenues were coming down as the world was going into lockdown. Quite the opposite. We were arguing to them that they should look after their workforces, that they should make sure that their employees could get time off, they could look after their families, that there were appropriate health procedures in place at their places of employ, as you would as a long-term business owner. And you know, we had some very pleasing dialogues with those CEOs. Separately, on the infrastructure side, the team reached out to the CEOs of a number of companies and utilities in the United States and suggested to them that they not exercise their contractual right to increase the rates that customers were paying on their electricity and gas bills. Because at the end of the day, as a long-term investor, do you really want to be hurting people that are currently going through the uncertainty of this terrible illness, uncertainty around jobs, just because it's written in your contract? And then, of course, with the utility space, there's always political ramifications at the end of the day. And if those companies did increase rates and acted on their contractual rights, well, maybe the politicians would have gone after them over the longer term. So we're very proactive in thinking about how do you enhance long-term value, and we actually worked with these companies to actually bear a cost in the short term, knowing that the long-term benefits were going to be there for our investors.
Diversity issues have also been very significant, with firstly the Me Too movement and then the murder of George Floyd in the United States. How are these issues being considered by the team?
Yeah, these are really difficult issues, obviously, and most companies are actually trying to do the right thing or improve processes in their recruitment, in their outreach, and also within their workforces, in promotions, etc. And we're certainly looking at disclosures and transparency of policies and their enactment in the companies that we invest in and that are within our universe. And we certainly look for targets and the achievement of those targets by companies, whether it's the number of women across the various strata of an organisation. And indeed, we are actively engaging in the proxy voting front during AGM time, the annual general meetings, when shareholder resolutions come to the fore that are requesting high degrees of disclosure, enactment of targets, etc. We will review those, and in the last reporting season that's just gone round, the proxy voting season that's just gone round, we have certainly voted in accordance with shareholder resolutions asking companies to provide more disclosure on their workforces, on their issues. At the end of the day, if you can measure it, you can do something about it. But we also acknowledge this issue goes well beyond the company. Quite often these are societal issues, and they have to be tackled in the educational space, in the political space as well.
Dom, when I think about sustainability issues, quite often it seems that the newspaper headlines have all the answers to often complex issues. It can't be that easy, can it?
No, quite often it's very difficult, and you really need to take a holistic, forward-looking approach when you're looking at some of these really tough issues. You know, if I was to talk about a number of simple examples, you know, Wells Fargo, about 5-6 years ago, one of the largest banks in the United States, went through a scandal whereby they were setting up fake customer accounts so that people could get, in the workforce, managers could claim sales targets, meet sales targets, get paid more. And it was an incredible scandal. But frankly, over a very short period of time, actually, those managers were removed, the CEO was removed, the CFO was removed, there was significant turnover at the board level. On a forward-looking view, a lot of those S issues within the ESG space were actually removed from Wells Fargo, and it presented itself as a more positive investment. When you think about a company like Facebook, there's pros and cons there, and you've got to look at these issues holistically. We're all aware of some of the challenges that Facebook has faced, whether it was Cambridge Analytica, some of the privacy issues, some of the bullying that takes place online. These are very serious issues that we do have to think about and engage the company with. But how about the positives? Where would the world have been over the last 12 months with small businesses marketing their goods and services on Facebook or Instagram? What has been the positive benefit to mental health when we've all communicated with friends and loved ones overseas on WhatsApp or some of the other products that Facebook makes available? So you've got to be very careful in weighing up the pros and the cons and ask yourself as an active manager, are some of the challenges more than incorporated in the share price? So for example, Jen, after the Cambridge Analytica scandal popped up on our screens, you know, very shortly thereafter, the Facebook share price came off some 20%. And then a few months after that, it came off another 20% again. If you had sold out of Facebook back then, you'd be underperforming the index by 25% now. It's our job as active managers to understand what the pros and the cons are, what's in the price, and actually engage with the company on dealing with those challenges as best we can. And we've done exactly that with Facebook, with outreach to General Counsel and some of their other members on some of the more delicate issues there.
There's certainly very good examples. Another tough one which comes to mind is the issue around the use of forced labour of the Uyghur population. How have you been thinking about that, and have there been any portfolio impacts?
Yeah, that is a very topical and difficult issue, and certainly we can say that we've actually gone through our portfolios and done due diligence on the Chinese stocks in our portfolio and some of the others, and it seems to us that there's very little exposure to the Uyghur forced labour issue, and if that exposure exists even in an immaterial way, it's not going to have a material impact on cash flows as those companies rectify those issues. But if I just step back and have a look at the bigger issue at here, we've really got to be careful and even-handed when we think about the ethics at play here. You know, at the end of the day, here I am, a privileged white Western male opining on these ethical issues. Through which eyes am I opining on these things? Am I being even-handed in judging these things? I really find it interesting that prior to the trade war between China and Australia and China and others, you know, I did not receive one phone call from clients asking me about the issues in Tibet and the cultural expropriation issues that have been there for more than 50 years. So there's a little bit of hypocrisy taking place. So suddenly when the issue is around a trade war, the focus is on some of these issues. Now, I'm not excusing some of the challenges that are being faced in the Uyghur population. I'm not just talking about even-handedness here. You know, so for example, you just asked me the question around George Floyd. Think about the institutionalized racism that we see in the United States and indeed even in our own Indigenous population in Australia, and more recently some of the terrible news that is coming out of Canada, how often do we ask ourselves about our own companies and what they are doing in their processes to stamp out racism, to stamp out other issues? So again, I just really need to be cautious here and even-handed about some of these difficult discussion points. Let me just really bring it home for you. The last time that you filled up your car with petrol, did you stop to think where that petrol came from? Most certainly came from the Middle East. Have you thought about what happens to women's rights, or indeed to the persecution of minorities, particularly in the LGBTQ space? How many people ask themselves those questions, and yet they go to the petrol bowser and fill up every day, and yet all of a sudden the newspapers are focused on this very challenging issue in the Uyghur population, and then trying to force investors down some path. Again, I just want to be very careful that we need to think about these difficult issues in an ethically neutral perspective, and not forget that we quite often frame the issue from our own biases.
Lastly, can we move on to environmental challenges? There's been a change in the United States president from a climate change denier to a science-based president. What are your thoughts on what this may mean for climate risks within the portfolio?
Well, actually, not much will have changed for the climate risks in the portfolio. And in fact, not much has really changed in the United States. When you sort of step back and have a look at the policies that were in place at the company level, at the municipality level, and at the state level, great swathes of the United States were already trying to track the Paris Accord. The problem was really very much around the White House and a number of conservative states. So the change in administration hasn't really shifted the dial as much as you would think. It is important, though, and it is a positive thing, that companies are more inclined now to disclose their climate risks, how they're dealing with those climate risks, and also setting an increasing number of companies are actually setting targets to be net neutral in terms of the amount of carbon that they're putting in the atmosphere within certain timeframes. And that really is quite encouraging. And we're certainly working with the companies in our universe to better understand where they stand on their targets, and making sure that they are, as best they can, be aligned to the Paris Accord.
Dom, thank you.
Pleasure, Jen.
And thank you all for watching. As always, please reach out to the Magellan distribution team should you have any questions, and feel free to share this update with clients and colleagues as you see fit. Take care and stay safe.